All right, everyone, it is right up on the top of the hour, so let's go ahead and get started. Again, this probably won't be as long of a webinar today, just kind of want to bring people's attention to kind of what's going on. I know people are getting a little bit overloaded with the news cycles nowadays, so maybe we can bring together a little bit of a update on kind of what is going on. Maybe maybe some people can make some informed decisions, or at least just get educated on some different things that you maybe weren't aware of on what's going on in the world. So here I am, my lovely face right up there. My name's Alex Perney. I've been with Advanta since 2012. I'm a certified IRA services professional. I have been working in the space extensively with alternative assets and people looking to kind of get out of the traditional stock markets, again, for about 10 years. So if you have any questions specifically on different investment types or anything else like that, feel free to fire them off into the chat. Again, if you do have any questions, do type those into the chat box as, excuse me, as all of your audio on your end has been muted. Let me just open that up real quick. Okay, great. A little bit about Advanta IRA. We have almost 20 years of industry experience, being founded back in 2004. Any cash that you would hold here is, of course, held with FDIC coverage. And we hold right now just about $2 billion of assets under administration with about 9,000 active clients. So if you have any questions or concerns about anything that you'd be looking to do, we probably have had some experience in doing that. And we do also offer dedicated account management to any of our clients that like to self-direct with us. A little bit about what self-directed IRAs are, and then we'll kind of get into the market update. The IRS does not necessarily give a specific guideline as to what type of assets can be held. So if you're a little bit nervous about the stock market or you want to get some diversification into other types of asset classes, the IRS doesn't necessarily write a rule book specifically stating, hey, these are the only types of assets that can be held. There are a few specifics on assets that you can't, namely just life insurance, and collectibles. So really with that kind of mindset, so long as you have a custodian willing to hold some type of alternative asset, we can typically make that work. Now, these types of assets that we hold are outside of the stock market, so you can kind of avoid some of the roller coaster effect that you do see with the stock market, which is a really great benefit to the service that we offer. So essentially, since they're not publicly traded, then the impact of the stock market fluctuations, and especially being evident this year, are not going to impact your returns as much. Now, we'll get into a little bit about rents and typically what the cash flows that we see from some of our clients are. And yes, they can be affected, but in generally speaking, when compared to actual market returns and what is actually happening and been happening over the past 6 months, generally you can see a much more stable line of of marketable income to your accounts. Now, with regard to what is happening in the stock markets and markets in general, all of these different types of plans can be affected and also can be used to kind of get out of the roller coaster that many people are riding. So anything from a traditional IRA all the way over to health savings plans are exposed to these types of market issues that we're going to cover here in a minute. And just keep in mind that just because you have one account type doesn't mean you can't necessarily switch and pivot to a different type of investment structure, specifically utilizing self-direction in that context. So with that said, let's look into a little bit about what's been happening in the stock markets right now. Now, companies have been releasing earnings reports throughout the year. Typically, they come on the end of quarters with publicly traded companies releasing what their expected revenues were for the previous quarter and whether or not that they actually met or exceeded those benchmarks. Now, some concerning things, at least coming in currently during the path of 2021, we had almost not many of the major benchmark companies on the stock exchanges exceeding revenue projections, which was great. These were really good things that were happening. Now, since the beginning of the year, we have seen a pretty marked decline in that, and kind of a concerning factor in that has been many things such as geopolitical issues, such as the conflict in Ukraine. We have worsening supply chains, extremely high inflation, different types of governmental actions from the Fed type of affecting these kind of things with the ability of these companies to actually make money. And we've actually seen companies missing their earning projected reports exceeding the amount from Q3 of 2020. So that was kind of right in the middle of the height of COVID, which is definitely kind of a big paradigm shift that we've seen this year is companies moreover missing these projected earnings reports. Now, this can be expected to a point. It's maybe not necessarily something that is as alarming as some of the other things that are going on, But it is definitely a concerning trend to watch, because if these companies are not making their revenue projections, then their underlying stock prices typically are going to edge down. Now, kind of an interesting factor of that is that roughly 1% of the companies that are missing their earnings projections are actually seeing a stock increase, which is kind of odd. But there was something in doing the research for this being reported on by Goldman Sachs, is that some of these companies, around 1% of them that do miss these earnings projections, have actually seen a market uptick in their actual share price. Now, looking at some of the large indexes, we have seen a bit of a rebound since August of this year. Now, not a whole lot, but we have seen some. Now, the S&P 500, which is a large index of kind of, think about the blue chip stocks, is down this year pretty significantly, almost 25%, 23.36%, and down an additional 5.18% since August. Now, again, looking at this, it's definitely concerning, because 500 of the most valuable companies in the world, as an aggregate average, are continuing to slide. The industrial average put out by the Dow Jones, still down 8.5% year to date, but it has edged up 1.09% since August. And the S&P Mid Cap 400, which is basically an index of tech companies, which have just been getting hosed this year, it's a very tech heavy index, has seen an increase of 1.02% since August. Now, this doesn't necessarily paint the whole picture of the markets, but it definitely gives us an insight into at least the health of them. We're not seeing kind of a general, we're not seeing a whole shift one way or another. Some of the markets are continuing to rise a little bit, some are continuing to kind of remain level, and some are continuing to drop. So with that said, it's kind of an interesting time right now. We have the Fed coming back in to hold meetings. They just started their meetings on a potential another rate hike increase. They actually just started those today. But it'll be interesting to see how that actually pans out. Now, last week, we saw an absolute mess in the markets. The consumer pricing index being put out by the Fed said that the pricing index went up 8.3%, and that is 8.3% from year over date from August of 2021. Now, this is a measure of the price of goods compared to the same time at a certain period of time, mainly last year. So the 8.3% for the CPI essentially means that across the board, prices have risen on everything from consumer goods to oil and gas to energy. Basically, everything that a consumer in the United States purchases has risen kind of an average of 8.3%. Now, this is huge, and it actually is a slightly less, the actual amount that it went up was not too huge. It went up 0.1% from the last time the CPI was released, but it hasn't actually gone down at all, which again is very concerning. Now, this is kind of tied to a lot of different things, continuing supply chain issues, different, again, political aspects that are playing into this, and a large part of that kind of just being the uncertainty of a lot of people in the market to say, hey, here's how we're going to price things, because they just don't exactly know what the stabilization of some of these different markets are, namely oil and gas being a very large one. We've seen huge fluctuations in this, which has seen pricing kind of go all over the place. The beginning, about Q2 of this year, we had a very high increase in the amount of money that people were having to pay for gas for their cars. Now, that is slightly edged down a bit, which is kind of playing into the fact that the CPI has not risen as much as it was in the first 2 quarters of this year, but it is still rising. Now, we've had some legislation come out, such as the Inflation Reduction Act. It's still too early to tell if that will actually have much of a bearing, if at all, on reducing inflation. So far, the reviews are kind of mixed. I did a podcast a few weeks ago on exactly what went into that bill, and from just looking at it on face value, there really isn't a whole lot in there that would markedly reduce inflation. But again, it's still kind of early to tell on exactly how some of this legislation that has been put out will actually come into play. Now, supply chain issues that I just mentioned are still very prevalent for a lot of industries. Ford just released information that they estimate over $1 billion in additional cost just in the next quarter for their manufacturing. So this is huge. So a company is not going to necessarily be expected to just eat the cost of an additional $1 billion of additional outlays. This is going to trickle down into everything from the price of cars to how much the used cars are going to actually still be going for, which is crazy enough to think that the pricing of used cars for the first 2 quarters of this year actually outstripped the S&P 500. So if you were buying and selling things like used cars, all else remaining equal, you could have made a higher return than was seen just by investing in the stock market, which I find just absolutely wild. But again, things like this are actually going to play down into what the end use consumer is going to see, and is going to also affect their ability to participate in things like stock markets and other types of asset classes. So with just things like this showing up of a company that is, again, a stalwart on being one of the more valuable companies in the United States, saying that just that one market segment is going, just that one company in one market is seeing an additional $1 billion in cost over just 3 months. Again, it's going to be very hard to justify how this is not kind of a warning sign of additional pain to come in stock markets, and especially in the manufacturing markets. Another interesting aspect is that the port authorities of West Coast major ports like Long Beach in California are actually seeing a slowdown in the amount of transit coming through those ports. So things that are getting imported from Asia and other parts of the world are actually slowing down on the amount of volume that is being seen. So kind of interesting to see that if we were seeing a increase in that rate and now a reduction in that rate, how that's going to actually play into supply chain issues, whether or not that is necessarily indicative of just the materials being less purchased, or if it's just harder to get. Again, that wasn't necessarily something that I saw when I was doing research for this, but the reports that there was actually a slowdown of the volume of freight being moved through some of the largest West Coast ports. Again, something to look at, and I think it's definitely an indicator of some additional pain to come. We've been talking about supply chains for the past 2 years, and I know people kind of get a little bit tired of it, but it is definitely something to keep an eye on, because it is going to directly affect the ability of some of these companies to make money. Raw materials, everything from silicon to make microprocessors, to fertilizers, to raw materials such as things like steel, aluminum, iron. These things are huge imports, and a lot of them come from places like China and Asia. And to see that a reduction in the amount of these things coming in through our West Coast ports, is where a lot of these materials come in, I think is going to definitely be indicative of kind of a further pain to be seen in the markets. While some things may have seemed to have stabilized a bit, and as indicated by the Dow Jones and the S&P midcap actually coming up over the past 60 days a little bit, I don't think that we're necessarily out of the woods on that, just by kind of some of the other additional factors that we're seeing. Now, the Fed is meeting today, and there is some uncertainty as to what exactly is going to happen. We've seen two 75 basis point rate hikes occur over the past two meetings, and from what I've been reading, it seems like it's going to maybe be another 75 basis point increase. Now, the 30-year fixed rate mortgages are sitting right around 6%. And in all honesty, that's probably what would be seen as a little bit more normal. For lack of a better term, people have had almost free money when it has come to actually borrowing money from banks to buy things like businesses, especially homes, is where we see a lot of this kind of trickle into. So with another basis point increase, it's going to definitely play into some of the issues that we're going to be seeing in the real estate markets. So definitely something to keep an eye on. I think this is going to be one of the biggest impacts that we're going to see probably through the end of the year, as to what direction some of these markets are actually going to take, and the effect that it's going to have on things like real estate markets. Now, the real estate markets, I think, for the investor might actually benefit from this, and I'll kind of get into that in a little bit. But definitely something to keep an eye on, as the Fed is typically been one of the biggest drivers of change in the stock markets as of recent. So again, another 75 basis point rate increase is expected. Again, we'll know more in the next coming weeks as to how this is actually going to play out. Now, the banking situation in China is definitely something interesting to look into. Most people would think that, when it comes to looking at foreign markets, and especially with China, you think a lot about things like raw materials. So, when you talk about banking in China, maybe people don't necessarily think that that would have a direct correlation as to something being things being affected in the United States. Well, that's definitely not the case. So to kind of get into a little bit deeper about what's going on in China, you have two big issues that are occurring right now. You have commercial real estate developers. Think about the Evergreen fiasco, which was the largest default of any commercial real estate firm ever in the world at many billions of dollars, several $100 billion, in fact, of default in that firm back in the middle part of last year. But what we also have is a worsening crisis, thinking about with regard to liquidity standards and people being able to actually withdraw money and use the Chinese banking system. Now, lots of people in China are kind of getting into the aspects of a little bit of what happened in the Great Depression in the United States, insofar as that company or banks were actually overextended on their debt, didn't have enough liquidity on hand to actually cover withdrawals, and essentially kind of creating a little bit of a run on banks. Now, the Chinese government has put in different stopgaps to kind of alleviate this, kind of bolstering up their version of the FDIC. But the issue is that if you have underlying issues with the Chinese population or Chinese investors not being able to get money out of banks, then they're going to need to create liquidity in other ways, which would typically be in selling other assets. Now, the Chinese investors for many years have been buying up all sorts of assets in the United States, everything from stocks, bonds, mutual funds, real estate. And this is kind of creating a dilemma for people, is that if we're going to see a continuing worsening of banking issues in China, we're only logically going to then in turn see a large amount of sell-offs of those assets that they hold in other countries. And since there is so much Chinese investment in the United States, then we could see a lot of selling of securities and other types of assets in the United States, which would again, basic laws of economics, supply and demand. If you have an oversupply, then the demand is low, the pricing is going to have to decrease as well. So a large influx of the selling of securities and assets in the United States markets by Chinese individuals or companies in general could definitely help to further depress the markets in the United States. Now, I say depress not in the context of putting us into a depression or anything, but definitely something to watch. As typically when you look at foreign governments, you don't necessarily or foreign countries, you don't necessarily think of their effect on the US economy as something more than maybe just supply chain issues. But the banking situation in China definitely has some real teeth to be able to tear into the markets in general. So something to watch. I always encourage people to look beyond our borders, because things outside of our control and different aspects of foreign government interaction, especially when it comes to banking, since we're such a globalized economy, can have significant effects on our economy. So something to watch. I think it's definitely going to be something that might get a little bit worse before it gets better, especially with the overall climate of the US markets kind of trending down at the moment, at least. Watching what's going on with the banking situation in China is something that I would recommend a lot of people do. Now, cryptocurrency, another kind of, just for lack of a better term, a bloodbath been happening for the majority of the year. Now, the NASDAQ just said that they will start institutional record keeping of cryptocurrency assets, which is good. I think the inherent additional adoption of cryptocurrency is going to be a good thing for the large majority of markets. But when you have this adoption and you have cryptocurrencies being just wildly depressed in value, it's hard to make an argument for it. Now, Bitcoin is down 59.1% year to date. I pulled these numbers this morning, so they are accurate. Ethereum, another very popular cryptocurrency, is down 63.5% on the year, and XRP Ripple is down 47.7% on the year. So while we're seeing a lot of interest from the larger players on Wall Street about adopting this and having it being an offering to kind of think about rank and file ordinary citizens, these are still very highly volatile assets, and these types of assets being adopted by more people with less understanding, while it still is not something that has a relatively price stable point, again, is going to drive, I think, a lot of uncertainty and volatility for people losing money in an already kind of overinflated economy as well. Out of the top 10 crypto coins by volume and value, none are over 50% year to date. This is excluding stable coins. Stable coins being cryptocurrency tokens that are basically pegged to a fiat currency value. Most of them use the US dollar as their peg. These are typically used as liquidity standards for different cryptocurrency markets. So just like the United States has different liquidity, uh, the use of the U.S. dollar as liquidity on markets for the sale and exchange of securities, the same kind of thing needs to happen on cryptocurrency markets. Without getting too deep into it, there have been some issues with the underlying liquidity going off peg over the past 6 months for stablecoins. So although the large amount of price fluctuations have been happening with the larger by volume and value cryptocurrencies, we are still seeing some issues with that. So just the kind of the market in general with cryptocurrency and how much people have invested in it, and just seeing how much value has been lost just over the past 6 months is definitely, again, something to be concerned about and to be watching out for, especially since these assets are going to be are continuing to be more entrenched into the more traditional securities and market trading. Now, a dip in Bitcoin is not necessarily going to cause the NASDAQ to implode, but if more people start adopting it, and then more companies and exchanges start holding these kind of assets, we could definitely see some issues with it. So again, seeing such large value swings of the, again, very large and well-established cryptocurrencies such as Bitcoin, Ethereum, and Ripple, it's definitely something to be concerned about. And if the continued adoption from larger Wall Street banks continues and these price slides continue as well, again, could be something very concerning. Now, another kind of concerning thing with the cryptocurrency markets is that we have seen over $1.2 billion in crypto hacks year to date. This is up 8% from the same time last year. A big concern is security when it comes to cryptocurrencies, and there's still things that are being figured out with regard to how these types of assets are traded and utilized. So for people that are looking to the cryptocurrency markets as maybe an alternative to traditional stocks, bonds, and mutual funds, there is still a very kind of wild, wild west feel to it. And people need to be very careful. And I would encourage people that are looking to invest in cryptocurrency to really do your research. Don't get into it without a good fundamental understanding of what it means to invest in these types of assets and stay safe. Because with everything being more expensive, with stock markets being depressed, a very easy way for people to kind of get in over their head and lose money is to be getting invested into cryptocurrency without a very fundamental understanding of how these types of assets work. And again, with more banks and more larger financial institutions starting to bring on these types of assets as options for their clients, it is going to potentially expose people to larger losses. And again, if these banks and institutions are starting to offer this and they have underlying vested interest in cryptocurrency, it could, and the theory would definitely hold true, if underlying assets start to lose value, like we saw with the 2008 financial crash with mortgage-backed securities, it could definitely affect these firms' abilities to do business. We shall see. But again, definitely something to look at with regard to cryptocurrency, because while it is definitely separated from the more traditional stocks, bonds, and mutual funds, there is a lot of overlap, especially with the additional adoption by these financial institutions. And it's just something to definitely keep a close eye on. Now, with real estate, we're definitely seeing some interesting things. I would say that while real estate is definitely kind of on the precipice of a few big issues, it definitely offers some security and alternative to people depending on what side of the coin you're in. Now, I mentioned the Chinese banking issues being kind of an issue for securities markets in the US, but the other big issue being, and it's kind of the other side of the coin of what's happening in China, being commercial real estate. So these commercial real estate investors, which have a lot of overlap between development in China and owning commercial real estate properties in the United States, kind of to give you an idea of what's happening is that they were developing these large commercial real estate projects in China, and they were then being sold on a pre-sale basis, meaning that they were still building these these structures and they were selling them to people and people were buying them and taking out mortgages on something that had not been built yet. Now, with COVID and all sorts of other things happening in the world, the rate at which these things were being built and also being finished dropped significantly. And these companies' ability to make money and not get involved in lawsuits and other issues with people that had bought and now were paying on mortgages just went through the roof. So with these commercial real estate developers have started to do, since they are getting strapped for cash and their ability to build and sell in China, these same companies also do have lots of vested interest in commercial real estate in the United States. Just this year alone, we've seen almost $23 billion in commercial real estate liquidations from Chinese companies. So we're definitely starting to see the effects of what this can do and how intertwined the development and in development in China is tied to the US real estate markets and security markets. We're seeing a lot of sales happening of these companies to try to raise capital as they're getting strapped for cash in their home country. Now, I would say that this is a good and bad thing. Now, bad maybe for the companies certainly that I don't wish ill on any investor, but with regard to that is also helping to bring up inventory slightly in the United States in the commercial real estate market. Commercial real estate has been an extremely hot industry over the past 5 years uh, with acquisitions and prices just continuing to kind of be on a 45-degree angle if you look at the chart. So being able to have some additional inventory and bring prices down a little bit of these assets that aren't necessarily affecting the US investor as much can definitely create some opportunity for people that are looking to maybe syndicate deals or maybe looking to get into commercial real estate. Again, this crisis is kind of continuing to go on. So it's not necessarily something that is going to be a light switch where these companies are going to just stop liquidating their US real estate holdings. It's going to create opportunity. Now, I'm always a little bit hesitant going back into the market update on securities to say that most investors should look at the old adage, if there's blood in the street, buy property. Take on securities, because price fluctuations can happen so quickly. We saw one of the worst days in the U.S. stock market last Wednesday and Thursday with just basically almost every single company that was the top 500 companies by value, almost every single one of them having a share price decrease. You don't necessarily see that kind of inherent immediate volatility in the stock market. So when you do see some dips and some additional inventory, it can create investment opportunity. Granted, it might create pain in some other places, but especially when it comes to commercial real estate, I think there definitely might be an opportunity for people, especially if maybe you were getting a little bit disenfranchised with trying to find deals, to maybe start kind of getting back out there and starting to pay really close attention to the inventory and where these properties from Chinese developers are being sold. It might create an opportunity for you to get in there and find some good pricing on that. Now, unfortunately, the stock market, or I should say the real estate market, isn't necessarily going to be something that is good news for everyone. Granted, there is opportunity out there for investors, but for the average American, someone that's maybe not necessarily looking to invest in real estate, their investment in real estate is going to be primarily their primary residence. There is definitely some pain out there, especially if you're looking to buy a new house or move. Things are not looking too great. The existing single-family home sales are down 5.9% from July of 2021. Housing inventory is up 31% from 2021, and that's the fastest increase since 2017. So the fastest increase we've seen in inventory on the markets in the past 5 years is occurring right now. Now, that depending on how much knowledge you have about real estate, that's not necessarily a good thing to say that you have a lot of inventory. That means that things are not selling as fast as they once were. Granted, I think it would be inappropriate not to kind of say that things have been moving maybe a little too hotly lately, and a cool down is maybe good for the markets to help increase the amount of affordability that we're seeing. The median home price in the United States right now is almost $425,000, which is absolutely wild. That's almost a doubling in 4 years of the median home price in the United States. So seeing some additional inventory and seeing some cool down on prices, I think will definitely help. And of course, that also plays into just how much more expensive everything else is, with the consumer pricing and inflation indexes being up 8.5% from the same time last year, and also seeing incredibly large increases in the amount or in the price of homes. Seeing a slight cool down on that, I think will actually be good for the economy in the long run. But again, we're going to have to wait to see how that plays out. But we do have additional inventory, and the time on market is increasing as well. So these houses not only are there's not only additional inventory, but there's also a longer time on market for them to sell, which again kind of plays into maybe a cooling down of the markets. Which, so long as that we don't see a precipitous drop off, will probably help the economy in the long run. But one kind of interesting thing to look at is that due to rapid rate increases, so the Fed continuing to raise rates on the money lending rates, which again factor into how much money or how much interest is charged by these banks to end use consumers for things like mortgages. We're seeing people, and I thought this was a very interesting fact, is that because rates have risen so much, and so many people were buying houses when money was basically free. Think about 2%, 2.5%, 3% on 30-year mortgages. That approximately 85% of homeowners have rates lower than today's current mortgage rates, which I just think is absolutely bonkers to think that so many people have interest rates on their current homes that are lower than what today's current rates are. Now, this was put out by Redfin. I always take a little bit of a grain of salt on where they source their information from, but I think it is something to definitely be aware of. I don't think that number is probably too far off with just how many homes have been bought and sold in the past 3 to 5 years, that a significant amount of homeowners do have rates that are going to be lower than what the current marketable rate for mortgages are. Let's see, we got a question. Do you believe that low inventory markets with high demand will outrun higher interest rates? Well, it's an interesting question. So low inventory markets, we are in a relatively low inventory market, but I think that we're going to continue to see the inventory of these markets start to increase as the higher interest rates start to cool down the market. So will the low inventory markets with high demand outrun higher interest rates? Hard to say, but we're still kind of in the very beginning stages of this. Just looking back to how cheap money has been for so long. If you've been investing in real estate, or you are just maybe over the age of, let's say, 45 or 50, seeing a 5 to 6.5% mortgage rate is what we saw for a long time. Coming through the 90s, the early aughts, up until the financial crisis of 6, 7, and 8. These mortgage rates, I think, are kind of starting to normalize. My parents, when I bought my first house, just looked at me with their eyes crossed when I told them I had a 3.5% interest rate, and then refinancing last year at almost 2.35%. It's just wild to see how cheap money was for so long. And then, of course, if you were an investor or a homeowner back in the 80s and early 80s and 70s, you were seeing double-digit interest rates. So the ability of the markets to absorb these is not unfounded from a historical point of view. Do I think that these interest rates will continue to rise till we get to some of what I would probably consider higher interest rates, probably getting to the 7, 8, 9, 10% range? I doubt it, because the government wants to keep the economy moving forward, and there really isn't a perceived benefit to having a huge glut of houses, or houses that won't move because people can't afford to borrow money. And I think the pain from that would be, overextended and protracted to the point where it really wouldn't be beneficial. But a great question. But I think it's kind of hard to say, just with what we're seeing right now, because it is such an unusual market landscape, from everything that we're seeing between COVID, supply chains, inflation being so high. We're kind of taking issues from multiple different decades and plugging them all into one market, where we've seen high interest rates from the 80s. We've seen supply chain issues in the 70s. We've seen inventory issues from the early aughts, but we've really never kind of seen a mixing of all of these things at one time. So to see how it's going to play out with regard to monetary policy and a lot of other things is going to be very interesting to watch. Again, it's it does get kind of played out to hear people say, we're in uncharted territory, we don't know what's going to happen. But that's exactly why it's important to stay educated. It's really easy to get apathetic to the news cycle of hearing all this doom and gloom and everything. But to be an informed investor, to be someone that can navigate this correctly, you really have to do your research and see where these different factors are coming into play and to make an effective investment strategy. Now, we're not here to tell you what the effective investment strategy is. I just want to give some people some good information and maybe some, to keep them from having to do, hours of research like I did for this, maybe give some people a little bit of an insight on where to go to kind of get the information that they need and to formulate a good plan. So with the increasing inventory and time on market, it's definitely going to create opportunities for investors. I think that the rising of the interest rates for people going institutional money route is going to absolutely be a benefit to people that want to do private lending with things like their IRAs, or people that want to acquire real estate at a deeper discount, or even offer people the ability to own or finance properties if you're trying to purchase them. I think we're going to kind of see a renaissance of some of the things that we saw back in the beginning part of my career, where we're seeing people get very creative when it comes to investing in real estate with things like owner financing, with people getting much more involved in lending on real estate. Because if you are an investor and you're seeing the rates of 30-year mortgages and all these other things start to increase, and you want to be, let's say, a hard money lender, you want to start offering money out there, it's going to create a lot of opportunity and a lot of benefit to people if mortgages are starting to get tighter if mortgage lenders on the institutional side are going to start tightening the purse strings and not giving out as many loans. It is going to create a demand for real estate investors to need money and liquidity. And if you have that in something like an IRA, I have to kind of frame it in the context of what we do. It's definitely going to create an opportunity for you to capitalize on some of the more expensive aspects, or the aspects of real estate that's getting more expensive. And also when looking at cash flow, when it comes to looking at cash flow from a securities market standpoint, when you have these wild fluctuations and you have let's say stocks that are down 50% on a portfolio, if you're invested basically just in a S&P 500 index fund, if you're seeing that amount of decrease in the underlying value of the assets and you're invested in dividend stocks, that essentially is a 50% cut in your cash flow if you're just basically focusing only on securities investing. Now, that's not to say that you should do one thing or another, but if you're looking for more stable cash flows, things like rental properties offer a very good hedge against some of that market volatility. Now, is that to say that rents will always remain high, or that you might not have to adjust your rents down year to year? No, but the stability of the cash flow, because you have things like a rental contract or a rental agreement, can certainly help to insulate you from that. So you might be getting, maybe slightly an alternative view on it, but the ability to have very stable cash flow is something that is very important in times like this. Rent rates are edging down slightly, but still people are being forced to rent. If you look at this in the context of the significantly higher median home price in the United States, of the increase in the amount of interest being charged on 30-year mortgages, which is going to directly kind of price people out of being able to afford homes, because of most people are looking at what is my total out-of-pocket cost going to be, is going to kind of force them into being renters for longer. Now, I don't necessarily think that that's a good thing for a lot of people, but it does create opportunity for people to invest in real estate and create stable cash flow, because so many people have to rent. So, capitalizing on maybe not the most ideal situation, but you're going to have a very large pool of people to rent to for the foreseeable future if you are looking to invest in things like real estate. Now, again, prices are inflated. Rents, I think, would probably be edging on the edge of not being affordable in a lot of markets. So you're kind of reaching the top of what might be able to be charged for both rent and home prices. But if you buy something right and you follow the market, you do have the ability to create relatively stable cash flows for these types of assets. And another interesting tidbit I came across is that although new home builders are cutting prices, permit applications are up roughly 1% from Q1 of 2022. A big marker of the health of supply chains is people building new houses. Things like lumber, raw materials, wiring were all very hard to get, and it caused a big decrease in the amount of new home construction through the beginning of this year. And you kind of followed that, not necessarily by new home purchases, because that can be affected, again, by interest rates and a lot of other things, but by the amount of permit applications that are being done in the United States for things like new construction. And to see those rising almost 1% is definitely good, because that's going to help increase inventory, maybe also help to cool down prices, and again, help to raise the benefit of investing in things like real estate. So some interesting tidbits that I found with regards to real estate, I think that are definitely some good things to watch out for. And I'll kind of show you how investing in real estate from a case study point of view, especially with IRAs, can be beneficial, and how you can actually frame that in the context of what's going on. Let's see. What are the odds, and this is a question from a listener, what are the odds of a true recession in 2023, and what are the probabilities of a short or long-term recession until recovery? Well, it's really going to determine on a lot of things. I really think that we're going to have to keep a close eye on just how many external factors are going to be affecting our securities markets. So things like the worsening issues in China with regard to banking and commercial real estate, the significantly depressed cryptocurrency markets. I know a lot of people, especially, don't want to think that that could have as much of an effect, but when you have financial institutions that are taking on the ability to invest in these types of assets, exposing people to that market volatility, and especially if they have underlying invested positions in these things. I mean, just looking back, we're seeing almost a 50% drop in the largest traded volumes of cryptocurrency. So, the odds of a true recession in 2023, I would stay away from kind of giving my opinion on that, but I would say this is that with everything that's going on, the likelihood that things get worse before they get better, definitely a possibility. But ways that people can try to insulate themselves from those kind of things, I think, is what I really like to focus on, is that we've been kind of fortunate in the past year or so, is that we've had a lot of things that have been relatively easy to identify with regard to issues in a lot of markets. COVID kind of exposed a lot of those, and I think that people have been a lot more in tune with what's going on. So while is there a possibility of something like a recession happening? Absolutely, there's a possibility of anything happening. But with the speed that we saw the downturns of, let's say, 2007 or the dot-com bubble, or the early 90s retraction during the Gulf War, or the savings and loans crisis that happened in the 80s, a lot of these things happened extremely fast, and it was hard for people to react. You see, just kind of like Black Tuesday events happening. I don't necessarily think that that would really kind of be as much of a concern now, because we have, again, people kind of paying closer attention to things, and things happening at a slightly slower pace. So what that's going to look like, again, I would hesitate to kind of give my personal opinion on it, speaking on an Advanta webinar, but it's definitely something to watch out for. But I think that there are a lot of tools out there, a lot of things that have happened over the past years that have been bad, but also good from the forecasting point of view, to help people try to alleviate some of the pain that we would feel if we moved into a recession. Let's see, can you talk about the future of industrial and multifamily real estate in a recession? Well, certainly. You have, again, with the liquidation, again, seeing about 23 billion of liquidations in commercial real estate in the United States from, again, foreign investors, and the continued popularity of people purchasing these types of assets. Granted, the rate increases, when you see them from the Fed, have a lot more zeros and commas to the bottom line of commercial real estate than you do with single family. But with that said, with rent still being high and people still needing to be, again, I don't like to say forced into renting, but kind of being priced out of purchasing homes, so you have a very large rental population in the United States, that would kind of lead to the assumption that commercial and multifamily real estate is going to be something that is going to be propped up if there is some type of, recession or something that would happen to that. Because, especially like we saw in 2008, yes, everything was hosed out, single family took a bath. But when people lose their homes, these people aren't inherently just going to be homeless. Granted, some of them are, and that is an absolute travesty. We hate to see anything like that happen. But more often than not, people are forced into renting, and you get a lot more population density into an apartment complex than you do single family homes. They're typically cheaper as well. So, with that said, and looking at people, large real estate investors. I was just watching a podcast that Rod Cleef was on the other day, talking about the issues that he saw in the 2007 crisis, was that the single family homes are what were the biggest issues. The multifamily during that time, at least for him and his investment strategy, did relatively well. So seeing people have an increased need during a time of economic downturn for some type of asset, in this case rental apartments, would kind of again lead to believe that that would be a bit of a good area to look if you were trying to find some value in a market that is as a downturn. Just kind of going on those just very broad stroked uh, kind of issues. If you have more renters and you have apartments, man, it might be a good thing. As far as industrial, that's hard to say. I mean, industrial, assuming that you're talking about like warehouse space and businesses, if you see a downturn in an economy, you might see businesses closing. You might see things like that happening. So with that said, industrial might be something that would be a little bit more exposed to market issues than things like commercial real estate for multifamily use. So, you're going to see a lot of different things happen between, just call it commercial real estate, depending on what the actual utilization of that property is. So, if people are being forced to rent for one reason or another, apartments could actually hold some value. But if businesses are going under or things are transitioning to a more of a drop shipped nature, you don't necessarily have as many people needing storefronts. And with the continued work from home that is happening along a lot of industries, take that for what it's worth. It might be something that definitely has a significant impact on the more industrial or commercial use case as opposed to the rental aspects of it. And again, that's just kind of the takes on it and looking at the numbers here roughly of what we might see with that. So going on, how can people, at least in this type of market, benefit from things like real estate? We're seeing a lot of things happen with the Fed raising rates. We're seeing home prices continue to be inflated. We're seeing rents slide down a little bit. But with that said, the benefit of having stable cash flow, at least from the investor side of things, can be a huge benefit. And going on and continuing into this, if you are acquiring real estate, and again, kind of what we do through an IRA, being able to functionally get your IRA out of a very volatile situation like it is in the stock market, can have some very significant benefits, especially with this how many different ways there are to make money on cash flow with real estate. Things like single family home, condos. Granted, Airbnb and vacation rentals might not necessarily be something that is as insulated from just the normal market concerns. You have people, they're not leaving their homes when their stock portfolio goes down, but they probably are canceling a vacation. So Airbnb, in the context of market volatility, again, you might see a slowdown in that aspect of it, but you still own a house. You could still rent it out to a long-term tenant. So the ability to change the use case and the strategy with things like real estate is a very big benefit in this type of asset class. So unlike a stock portfolio where you say, okay, well, I have to buy and sell something in order to make either a gain or change my position on how I'm actually doing things, real estate, you can flesh out in a myriad of different ways. You can rent it out, you could master lease it, you could owner finance it, you could do long-term lease, short-term lease. There's a bunch of different ways to create cash flow with these types of assets that you don't have with a traditional stock portfolio. And the different types of assets that you can actually invest in with regard to real estate are as varied as the ways that you can utilize it. So things like multifamily syndications, and a lot of other different types of things. And also with the alternative asset side of things, with money getting more expensive, you could, and then in turn, start being the bank in a sense and lending out to people. Things are going to be getting harder to finance. Things like private business loans, mortgages, again, are getting harder to acquire, and the prices for those are starting to increase. So maybe taking the alternative approach to actually the traditional side of things and getting into the alternative asset class could be a benefit to you as the investor. It's just freezing up a little bit on me. Okay, so purchasing real estate, and again, we always go from the viewpoint of doing this through an IRA and just showing how you can take something that you otherwise wouldn't be able to utilize in a traditional sense. So think about your retirement planning. Most people are always of the assumption that it has to be under the guise of some type of securities umbrella or invested in the stock market, which is certainly not the case. So how would this necessarily work? So John has an old 401k that's getting hammered in the stock market, and he finds a property to purchase down the street from his house. Total investment will be 150K. I know I should probably update maybe some of the numbers on this to reflect the higher home prices. Again, median home price being in the mid fours, but you can kind of take this to the context and extrapolate. So he has the 401k that again is big getting hosed in the markets, and he wants to get a little bit more stability in his portfolio for his retirement. So he finds the property to purchase, and he's going to make it into a full-time rental. So he's going for the stability of cash flow from rent. So what exactly goes on in this context? He needs to open up an IRA, we get the rollover in, and then he works with us to actually purchase it. But let's look at what's actually going to go on with the cash flow of this property. The property is going to net cash flow of $1,500 a month. If he sells the property down the road, all the profits are tax-free in this scenario by using an IRA. No taxes are paid on the rental income, so unlike doing this personally where you would have to do either complex tax planning, you get to completely exempt yourself from taxes on real estate, granted not property taxes, but you get to have a very stable cash flow that you don't have to worry about being affected by your personal tax situation if you're utilizing a retirement plan. And then you can use the cash flow to do really anything else you'd like to with it underneath the context of the IRA. You could buy securities if you wanted to try to buy at a dip. You could buy a new property. You can invest in different types of assets. There's a lot of different things that you could do in the context of buying real estate for cash flow. Now, I mentioned private lending also kind of being something that people should look at with money getting much more expensive, especially for investors. If you have people that are investing money and you have people that are investing in real estate and you would like to offer a different avenue for them to finance their properties. And again, there's a lot of different ways you can do this. I've gone on a webinar about being the bank with things like equity participation. If you want to give them maybe cheaper money for an ability to expose yourself to the appreciable gain and the value of the property, a bunch of cool ways to structure loans, especially if you're doing these through an IRA and not having to pay taxes. But if you're looking to maybe be the bank and step into that to kind of fill that void where money's getting more expensive, here's a context and a case study to kind of illustrate how that works. So Andrea has $150,000 in an IRA, and she wants to get monthly cash flow on her funds. Now, granted, your mortgage payment back is going to be maybe cheaper than a marketable rent, but you have the stability and the security in this instance of not having to worry about stock market fluctuations. And if, let's say, the person stops paying Andrea in this case, she could foreclose on the property and then take the property back into the IRA. And now she has a piece of real estate that she can do whatever she wants to. She could own or finance it. She could sell it outright and just take the capital back into the IRA. A bunch of different things she could do. So in this context, she meets Steve at a local investor group, and Steve wants to acquire a rental property for 200 grand and has the funds for a down payment. So she does her due diligence on the property, and she agrees to give Steve a mortgage on the property for the collateral on the loan. So she'll decide what terms of her loan would be, and Steve can certainly negotiate that as well. And the great thing about being a lender, especially if you're trying to get and be a little bit more stable in your investments, is that you get to choose everything about these types of assets. You're not just kind of locked into traditional things that, if you go to a more traditional lending institution is going to give you. You can choose everything from how much you're going to lend someone to what the interest rate is, so long as you're not violating usury laws. You get to choose how long your money is going to be out there, what the amortization, equity participation, fees, late payments, everything. You get to really tailor make your investments when it comes to private lending. When I say private lending, you or your IRA lending someone money, you get to tailor make every single thing about it, and it's contractually obligated to run like that, as opposed to buying stocks, bonds, options. You have so many other things that are external from that, and you have very little control over past just the research that you've done. Investing your money into an asset like this gives you a high degree of flexibility on exactly what you do with it. And again, this is not for Advanta to say how you do it. You get to negotiate all this on your own. So get the page to go. So what does this look like from a case study standpoint? So the terms of the loan, again, Andrea got to negotiate all of this. She lent Steve 150 grand at an interest rate of 8%, 2-year interest only balloon, and a monthly payment of $1,000. And she holds the mortgage on the property. The note is prepared by the attorney. She read and approved everything. Um, and the loan was funded. So what does the cash flow look like on this property? So Steve rents the property for $2,500 a month, sending $1,000 to Andrea's IRA. If she's over 59 and a half, she could just take it out and pay taxes on it, do what she wants to with it, or continue to compound it, maybe do another investment with the returns into the IRA. So when the 2-year balloon hits, Andrea could extend the note. So you're under no obligation to say, hey, you know what, now I got to find a new borrower. If everything's working well, and let's say Steve wants to continue the agreement, she could extend it. Or if they wanted to continue with the ultimate term of the note, again, you're not dealing with a huge bank here. You're getting to deal boots on the ground with the investor and create something that works well for both parties. So instead of kind of going to a nameless, faceless bank or dealing with that can be a benefit if you're trying to get out there and lend money to people, is that you get the personal touch and the ability to really customize these types of assets to both of your benefit. So with that said, again, I wanted to kind of keep this a little bit shorter. I know this is kind of a lot of information for people to take in, but I guess we really covered the whole hour. So I guess I can talk. But with that said, I always want to encourage people, if you want to try to get out there and learn more about what's going on, we have great events. We do bi-weekly webinars. We have a podcast that's hosted every Wednesday. We also have every other Friday, we have our Pitch, Promote, and Prosper event, which is coming up this Friday, where we put it out to all of our contact lists for people to come. If you want to pitch an investment that you have, if you're looking to find an investment, or you're just looking to get some information on how maybe you can diversify your investments, you get to kind of use the power of groupthink for that. We don't record the session. It is strictly the participants that participate in it. We just offer basically the Zoom call for that. So if you want to attend, just go to our website. You can register right there. I hope some people found some value to this. I always enjoy doing research on this kind of stuff, and I hope maybe that if you weren't aware of some of these things, that you can be better informed. If you knew everything, well, awesome as well. If there's any questions, I don't think we maybe have too many of them, but I want to say thank you to everyone that attended today. I really appreciate it. I enjoy putting these on. I hope it comes through in that way. So I'll stick around for a few more minutes. If anyone has any questions, please feel free to reach out to me. I am happy to answer them. Share the slides? Yeah, absolutely. If you shoot me an email, I will send you the slides. So my email is right up there on the screen, aperney@advantaira.com. I will shoot you a copy of the slides if you would like them. All right, I'll see people starting to drop off here. Again, thank you everyone for joining with us today. I hope you have a great day, and we will see you on the next event.